Farfetch is a hypergrowth stock that's put its investors on a roller coaster ride ever since it came public. This former high flyer reached $69 per share in 2021, but has been on a sickening slide ever since. But what does this company do, and is right now a good time to buy? Here's everything you need to know about Farfetch. My name is Brian Feroldi.
And my name is Brian Stoffel.
Thanks to StockCard.io for sponsoring today's video.
Brian, Farfetch was once valued at over $20 billion, but today it trades for about $5.5 billion, and it trades under the ticker symbol FTCH.
Farfetch is focused on the luxury good industry, and its mission statement is to be the global platform for luxury fashion, connecting creators, curators, and consumers.
Now, you might think that this is a relatively straightforward business to understand. You go to the website, you pick out some ridiculously priced goods, you order them, and they get delivered. But we want to highlight a number of different business divisions that this company is focused on.
The first division is its luxury e-commerce marketplace. Farfetch runs the #1 online global site for luxury fashion, connecting more than 1,400 luxury goods sellers with 3.7 million consumers. And in 2021, its gross merchandising volume reached $4.2 billion.
The second is Farfetch's platform services. Now, here the business is building and implementing tech driven e commerce solutions for their luxury brands and their partners. If you partner with Farfetch, then you have access to ancillary services like digital marketing, production, customer service, and fulfillment.
Third, Farfetch operates something called Farfetch Store of the Future. This is the company's innovation arm, and their goal is to develop tech solutions that blur the lines between physical shopping and digital shopping. Farfetch is using big data and artificial intelligence to try and resemble the professional shopping experience that you get when you visit a luxury retailer in the digital world.
And finally, the company has their own first party luxury goods that they sell online and in brick and mortar stores. Importantly, part of this is an incubator group called the New Guards Group, where they take up and coming brands and nurture them to try and grow their sales.
Now, when Brian and I were researching this company, both of our heads hurt. There is a lot going on in this business, and it's fairly complex to understand. Now, what we do know for certain is that Farfetch is currently spending hugely to acquire new customers and luxury brands. For that reason, its customer acquisition costs are very high.
Now, when we evaluated the customer demand, we had a tough time, and here's why. No matter the macroeconomic conditions, people who have a lot of money are going to be able to spend a lot of money. Usually, they're not super hurting when we hit a recession. At the same time, we've seen growth slow for Farfetch, and the reason is that those same customers are returning to other brick and mortar stores instead of going online to buy their goods. So we gave it a medium rating.
We also had a hard time figuring out how much of this company's revenue was recurring in nature. On the one hand, platform revenue is definitely recurring, as are those Farfetch services. On the other hand, luxury goods tend to be sporadic purchases, so we gave the company a medium rating here.
Now, turning towards the company's moat, by far its most important one is the network effect. They've got over 1,400 different luxury fashion retailers listing their goods on their site, and that's because they get access to 3.7 million shoppers of such luxury goods. The more shoppers attract more brands, and more brands attract more shoppers. Classic network effects.
There's also an argument to be made that there are some switching costs at play here. Not only for the luxury brand shoppers, they go to one place and they get access to a huge number of stores, but also for the merchants themselves. Once they list on Farfetch, it becomes a pain to switch off.
After that, we want to give Farfetch a little bit of credit for their brand value. As best we can tell, this is definitely the largest platform focused on luxury goods in the world, and so becomes the go-to destination if you want to buy such things.
We went back and forth debating whether or not this company had counter positioning. We decided to not give them any credit for this, but you could make an argument that it is there. However, given the recent growth in the number of luxury brand partners as well as the number of active shoppers, there's no doubt in our minds that this company's moat is expanding.
So how's the company doing? Well, if we look at sales, it's doing very well. Obviously, it was helped by the pandemic, but revenue is growing at a 50% clip over the past 3 years.
Gross margin here is a little bit wonky given that there's so many business divisions, but the consolidated gross margin for the company is about 45%.
Now, when we look at net income, things get really confusing. It appears that over the past year, the company has actually turned a profit, but when you dig into it, much of that has to do with the underlying investments made by the company, and it is not an accurate representation of the direction of the company's financials.
On that front, front, we think that free cash flow is a better metric here. And while the company was nearly break even in 2020, the investments have ramped back up in 2021, and the company is currently burning about $500 million of free cash flow each year.
That's okay for the time being because the company has about $1.5 billion in cash on hand and just about 500 million in debt.
Now, because the company's net income from 2021 is not repeatable due to the fact that they were made by investments, we think that the company's returns on capital are currently negative.
Farfetch was founded and is still run by Jose Neves, an industry veteran, and it's important that he remains at the helm because he understands the ins and outs of this particular niche.
Neves seems to get really good ratings on Glassdoor.com from his employees, so that's a really good sign for investors.
And insiders combined, led by Neves, own over 13% of this company. That is about $750 million.
Let's take a look at potential. When it comes to optionality, both of us were very impressed with the number of ways that this company can generate revenue. In fact, the company's optionality rating is so high that it actually could be a cause for concern that the company is spreading its resources over too thin of a base of business.
Now, because it has its focus on all these different areas and it's investing heavily in them, operating leverage is quite low right now. On the flip side, that means there's a lot of room for it to improve moving forward.
Now, the global market for luxury goods is absolutely massive with more than $300 billion in annual spending. Of that number, Farfetch is capturing just over 1%.
And it's worth noting that most of Farfetch's growth is organic. Its New Guards group is focused on getting smaller brands and acquiring them and nurturing them to grow their sales, which is something to keep an eye on.
So, how has the company performed for investors so far? The answer, sadly, is not good. After its recent drop, this company is actually dramatically underperforming the S&P 500 since it came public.
That's not because it's necessarily disappointing Wall Street, though. Over the last year, it has met or exceeded analyst expectations every time.
And since the company is not profitable or free cash flow positive, it is currently not focused on returning capital to shareholders at all.
Turning to risks, it's worth looking at the competition. We rated this as a medium level risk because Farfetch is so much larger than all of its competitors. At the same time, we want to remember that each of its brand partners would probably like to have people coming directly to their website instead of Farfetch's. Another thing to keep an eye on.
Now, there weren't any notable concentration, dilution, or disruption risks. One thing we did note is that this is a very complex business to analyze. Both of us heads hurt as we were trying to learn exactly what this company does. That is definitely a risk for investors. As we noted before, for example, you can't rely on net income currently to figure out if this company is doing well.
It's also worth noting that just 27% of the company's revenue comes from the Americas. The rest is spread out throughout the globe. And as you can imagine, when geopolitical forces come into play, that could threaten Farfetch's business.
As for outside forces, you could make an argument that the company needs a strong economy to drive luxury goods sales, but we actually don't think that that's a huge risk.
And finally, a first for our series here. This is a company that actually has a very reasonable valuation. Farfetch, after falling roughly 80%, trades for about 2.5 times sales and only a little over 5 times gross profit. We think that's pretty cheap.
So, what do investors need to tell if this thesis is on track? First, keep an eye on gross merchandising volume. We want to see this number continue to grow rapidly, which indicates that Farfetch is taking share in the luxury goods market.
Second, as we pointed out, Farfetch is focused on a whole bunch of different areas. And what we want to make sure is that they're making money in all of them. So we want to see that gross margin consolidated grow from its 45% value today.
Third, keep an eye on free cash flow. As we noted before, net income is currently not a reliable indicator. Free cash flow is a better indicator of this company's financial health. Eventually, we want to see this company flip to profitability before it has to dilute shareholders. So, how did this company score on our investing checklist? The answer there is okay. On mine, this company got a 63. That's not all that surprising given that this company is unprofitable and has been such a horrific investment so far. But my gut feel is that the company's score is actually a little bit higher than that, although I'm not interested in this stock right now.
And on my framework, it got an 8.5, which means I can see why this could be a very good investment moving forward, but I'm not convinced that its moat or its optionality are as durable as I would like to invest in.
All right, we made our call, so let's head on over to stockcard.io to hold ourselves accountable. All right, Brian, so we're at stockcard.io. So let's head on over to our portfolios. I'm looking at the anti-fragile portfolio. I'm going to go down to create a new order. Ticker symbol is FTCH. We're going to do a buy decision. Today's date is the 22nd. This is a $15 stock, so we're going to buy 64 shares. The score on your platform was 8.5. Let me submit. Next, we're going to head on over to my anti-portfolio. So this is my thumbs down portfolio. and I'm going to do the exact same thing.
And while Brian does that, we want to remind folks that you can head on over to stockcar.io to follow these portfolios, or if you want to, enter the Beat the Bryans contest, where each of us chose 5 stocks that we think would do the best in 2022, and you can do the same. If you beat us, you'll have bragging rights, and if you come in first place for the year, you'll get a $1,000 prize.
Overall, both of us think that there are plenty of reasons to be bullish on Farfetch, but this is just too complex of a business for either of us to consider owning. Brian's out.